You are listening to Keystone's Stock Talk Show, episode 306. This week, I will kick off our Your Stock, Our Take segment with a question from a client and viewer on Bowman Consulting, symbol BWMN on the NASDAQ, an engineering services and program management firm which is up 60% year to date and has returned for our US small cap clients 110%. I will let you know what is driving the stock going forward. Second, Brett takes a look at Roblox Corporation, symbol RBLX on the New York Stock Exchange, which operates a user-generated online gaming platform where users create, share, and play games developed by a global community. I know it well. My daughter plays it too much. The stock has been on tear this year, and Brett lets you know if the cash flow currently stacks up to the hype. And last but not least, Aaron gives us his take on the global sales giant in the CRM field, Salesforce, symbol CRM on the NASDAQ. Well, let's get to the show. We welcome my co-host, Mr. Aaron Dunn, one half of the Killer Bees. Brett, as Brennan, is somewhere in the bushes. That's all I know. Isn't he? Somewhere? Do we know where he is? Is it Waskesiu, or am I just some lake?
Something like that. Some lake in Saskatchewan.
I was talking to Devin earlier, and I was like, Saskatoon, Waskesiu, and I'm like, these all sound made up. It just sounds like a fairyland place. So that's what we believe. He may be somewhere in Disneyland. Actually, I don't know. All right. So we have a poll question? Do we want to get to that?
Yeah, we can get to the poll question. So it's
sure.
Just
or was there anything else anyone wanted to talk about? I went water sliding.
You did go water sliding.
I brought my sister on there, who's like, she's like 64, which good shape, all that. She's fine. But I went down with the kids, my daughter and her two cousins, so they're all the same age, 10. Fine. This one ride, this large tube with like a bottom on top of it, so your legs aren't going through. You're sitting in that. Totally fine. So I'm like, my sister, who'd been on like one and maybe was going to go on 2 rides. Yeah, this one's fine. Let's go on it. Myself, Candace, her get into it. And of course, we have more weight. We didn't factor that in. And we just start ripping down this slide that's this U-based slide, large, and you start going up like a half pike up the sides. And long story short, but my sister, who just had knee surgery, ends up like she is completely vertical. And then the next time she starts going over top of Candace, holding on for dear life with this terror in her eyes. I'm trying not to laugh, which is horrible.
Be serious. You were laughing.
Well, I said, you won't get that much weight. You won't get wet, right? And no, she's soaked. I'm absolutely soaked. We're drenched. And they literally think we're either going to go over the side of the U, or they're going to pancake each other and land on, because they're going one side of the U. And there was just terror, and she gets off. She's shaking. I mean, it was memorable. We're good. We lived through it, but it was super fun for me. I think they honestly almost had heart attacks. So that's my story from the water slides, which really has a lot to do with finance. So, but we're gonna get into that poll question, which has nothing to do. Next week, it's about your favorite water slide experience. You could
probably find some analogy or story and work that into a finance
Didn't have time,
while you're riding the waves of the market.
Oh, yes.
Toppling over. And
isn't there an Elliott wave theory? Elliott wave theory. There we go. Let's not talk about that. Yeah.
Integrate a bunch of things we know nothing about.
Yeah. Perfect. All right, Brett, what's the poll? What was the poll?
Yeah, so nice and simple question. When you invest, what's your top priority? 24% of our viewers said maximizing returns no matter the risk. 64% said finding a balanced mix of growth and stability. 6% said protecting their principal and avoiding losses. And then 6% said earning consistent, predictable income.
Did you guys vote? I'd say a balance between growth and risk. I mean, you want long-term growth, but you don't want to lose all your money.
I mean, perhaps I wonder if like a lot of the people that answered that question are really trying to say that I'm willing to take a lot of risk because, to get growth. But then that's all relative to what your risk tolerance is, right? So if you're
age, risk tolerance, all those things
with a lot of financial resources, then you can take a lot of risk. If you're If you're not, if you're a pensioner, retired, then
I mean, and our answers are skewed. We can take more risk because we do this on a daily basis. But I mean, you want to mitigate that risk. There's one growth stock versus growth stock A versus growth stock B, and a regular investor may look at those similarly. There's wildly different growth or risk profiles between many companies. So you try to find the unicorn, which has less risk, higher upside. I mean, that's what we're trying to do. Difficult to do, but that's what we're trying.
Well, you're managing the risk. You're going after the high performing opportunities, but you're not ignoring the risk. You're managing the risk, right? So, I mean, there are things you can do where the upside opportunity is extremely high. Playing the lotto is one of those things, but the risk is, it's not an investment. So it's investing. The difference between investing and speculation is ensuring that both sides of that equation are balanced.
For sure. Brett, what did you vote?
I actually was thinking even maximizing returns. Just I can take on the risk right now. Like,
hey, you're younger than us.
I am. Younger.
I think maximizing returns. I'm always
you don't care about risk. You don't look at risk, is what you're saying.
I do, obviously.
Yes.
You I do, but I would take it more in the sense of I am looking for the highest expected return on average. So like that, the key word is expected, which I know that means something to these guys, but that's just pretty much if you take all the results and you weight them all, that's your expected return. That's what I'm getting at, is looking for that. If it moves up and down a ton in the meantime, that doesn't really matter to me at this point in my life.
Yeah, makes sense. All right, well, let's just launch into the show. We don't have as much inane banter today because Brennan's not here, so that's he would say
you can make up for it.
Yeah, all right. I'm gonna share my screen here and get to Bowman. So clients of KeyStone's U.S. research should be familiar with Bowman. It's performed well after being recommended in the $18.84 range, and it's trading just under $40 today. It's up about 111%. What does Bowman do? Well, they are based in Reston, Virginia. They're a national engineering service company and program management firm. The company's core business involves delivering infrastructure, engineering, technical services, comprehensive project management solution to a diverse client base comprising owners and operators within the built environment. Its market cap about $689 million, trades just under $40. Like I said, doesn't pay a dividend. But what makes Bowman different from many construction or engineering firms, their key differentiators, I would say, is no general contracting. Unlike many engineering firms, Bowman does not engage in general contracting or design build projects. This strategic decision allows them to help avoid the financial risks associated with construction delays, cost overruns, and liabilities for a project's physical completion. Their role is to provide the expert planning and design services, not to execute the construction itself. Service-based, low inventory model. That kind of makes Bowman stand out. Their business is centered around providing intellectual and technical services. They don't carry significant equipment inventory or physical assets that could devalue or create financial risk. Their primary costs are internal labor and other professional expenses, which are more predictable and controllable than capital costs and variable expenses of a contracting firm. They are a growth by acquisition story, but they do also have organic growth. Their growth strategy is heavily based on acquiring other engineering firms and consulting firms. This allows them to quickly expand their geographic footprint, diversify their service offerings, and add new talent and clients without long-term high-risk capital investments of organic expansion. However, they're still growing, and even in the last quarter, out 8% organically. If they had zero organic growth, we'd be less attracted to the business. Their revenue is derived from four core areas. Building and infrastructure is by far the largest at 46% in Q2, consisting of 21% commercial, 17% residential. 22% is power and utilities and energy, consisting of traditional energy. That still makes up the most here in this category. Energy transition and renewables, and data centers, which are growing at present, the latter. 20% of the business is transportation, consists primarily of roads and bridge work. And 12% finally is natural resource and imaging. Let's look at the stock over the past month. Strong performance here, up almost 26%. We see over the last year, it is up, or so year to date, it's up around 60%. So what is driving the share price performance? Well, there's a number of things, but as with most businesses that we like, it starts with strong financial performance. We can see here, gross contract revenue is up 17% in the last quarter. Gross margin up 120 basis points. We can see net income. That is the real kicker here, up 386%. And on a per share basis, net income was up significantly. If you look at adjusted EPS, it came in at 56 cents per share from basically a loss in the same period of last year. Now, they also increased their guidance as well, and that is driving the share price higher, as we can see here. Now, it's not just this quarter that they've increased their guidance. We can see here there's a string of consecutive higher guides from the company, and that is driving the share price forward. Let's look at the rationale for the raised guidance. They have strong demand and bookings. The company is experiencing robust demand across its core verticals, particularly in transportation, renewables, and energy transmission. This demand is translated into record bookings during the second quarter, resulting in a book-to-bill ratio exceeding 1. Management has reported that bookings in the third quarter are already surpassing those of the second quarter. So, it's good to have a good core in the current quarter, but stock market is always looking forward. The fact that they're looking at bookings in the third quarter already surpassing those of a strong second quarter indicates some sustained momentum here. Record financial performance. You can see there, we talked about that in the quarter already. You looked at the numbers there. Operating leverage and margin expansion. The company is observing what we would call a scale effect, where revenues growth outpaces overhead and expansion. This is leading to margin improvement attributed to disciplined labor, cost management, and an optimized workforce and utilization in the workforce. There's diversification and organic growth. We talked about that, but Bowman continues to benefit from diversification of its revenue streams. Their revenues come from across their verticals, like we saw a number of different areas. Notably, transportation grew by 21%, natural resources and imaging grew by 19%, power and utilities and energy by 5%, and building infrastructure by 4%. So across the board, really, they're seeing growth. That healthy backlog, substantial, almost 25% growth in gross backlog in the quarter, provides significant visibility for the remainder of 2025 and into early 2026 at this point, underpinning future performance. You can see here, there is a compounding story in terms of their gross backlog growth over a significant period of time back to Q1 of 2021 here. It's compounded at an annual rate of 37%. So strong growth there. Let's look at the valuations. Well, the numbers right now look quite high. But if you recall the last quarter, the Q2 numbers that we talked about, they went from a loss position to a significant profit. We think that PE will move lower quickly. Again, in the last quarter, on a GAAP basis, they had 25 cents per share in Q2, earnings from a loss of 24 cents on a GAAP basis in that quarter. And the adjusted diluted were 55 cents, up from a loss of 3 cents. And those numbers significantly exceeded analyst estimates. So the estimates that we are looking at here are likely low right now and lagging the fact that the last quarter was strong, and they're guiding towards a stronger quarter coming up. The price to cash flow ratio on a trailing 12 months basis looks a little better. It's in the range of 20, not overtly high for a company with organic and acquisition growth. So the conclusion here, it's a quality business, well run, with a growing backlog, both organically and via acquisition. Valuations appear higher, but are quickly moving lower. Clients will be updated with our new rating over the next 10 days. And there is ownership here. That's the disclosures.
Yeah, I was just going to say that it's interesting how these engineering and construction service companies have really become so attractive to investors. and a lot of that being like the AI build out, and then the build out of the required energy infrastructure to power it all. And then, of course, there's just the infrastructure deficit in North America. So a lot of investment needed there, and some of it happening. So this is what's driving a lot of this growth in the engineering space, and overall higher valuations for the companies.
Yeah. And then data centers are a big driver. They're still, for Bowman, they're still smaller part of the business, but people, they're assigning a higher valuation to these companies that we've seen in years. So you do have to be careful. Will this continue going forward? We have to look back at historical numbers on many of these businesses, because some are trading at the upper end, significant or well beyond their historical multiples if you look at 5 years, and we'd be a little bit wary of that for businesses that have never traded really consistently at those type of multiples. All right, let's move on to Roblox Corporation. Brett's going to take a look at that company. I know that I see Roblox on almost a daily basis. We kind of shunned it for a while, but you can only hold off the Dress to Impresses and I think it's 99 Days in the Forest or something like that. These games that get super popular. And there was so about in the last week, Lady Gaga, I don't know how I know this, but I know how I know this, but she did a collab, they call it, with Roblox on Dress to Impress. And like literally that's all I heard about for a week. What?
Was it actually Lady Gaga?
It literally was. So she literally
my
did.
Told me about that, and I questioned.
See,
was Lady Gaga.
You thought it was fake, right? Like,
I just don't believe everything you hear on the internet.
No, it was, and she was playing. So everybody was on there trying to. I'm gonna log into a server with Lady Gaga. I'm like, that'll probably happen.
And then the server shut down.
But no, there's I don't know, the clothes or something that she did, but Brett was super into it. That's all I know.
I'm definitely the one who did do it here.
Yeah.
But Roblox Corporation, the corporation, unfortunately for Ryan, not the game in this case, but they do make the game, or games, I should say. So symbol RBLX on the New York Stock Exchange. It operates a user-generated online gaming platform where users can create, share, and play games developed by a global community. The company generates revenue primarily through the sale of its virtual currency, Robux, which I'm sure both of you two are very familiar with at this point, as well as the advertising partnerships and now premium subscription service. The stock has just had a great year, up 187%. The stock is trading at $117 a share with a $81.3 billion market cap. Although the stock has recently fallen off its high at the end of last month after its Q2 earnings set a nice high, but it's come down from that a bit. However, if we zoom out a bit, looking at just since its IPO, it really had a price mania like many other stocks during that late 2021 period where everything was just absurdly expensive, to say the least. And it's really trading around that same range now, once again, after a few years really of quite a bit lower, trading $20, $40, and now we're way back up in that $117 range. So first up, let's look at some of the most recent financials. Some of the headline figures. Revenue was up 21% to $1.08 billion, driven by significant growth in active users and bookings per active users. Bookings were up a whopping 51% to $1.44 billion. Massive increase there. Operating loss, however, was at $322 million compared to operating loss as well of $238 million. Adjusted EBITDA was down 72% to $18.4 million. The major factor between that adjusted EBITDA and the operating loss is stock-based compensation on top of some depreciation, amortization. But the stock compensation was actually $285 million during the quarter. So a massive stock compensation expense, to say the least, when you're not even an operating profit. EPS fell to a further loss of 41 cents per share from a loss of 32 cents per share. But the KPIs, the key performance indicators, were great. And that's really what the market reacted to, sending the stock higher at the time. Hours engaged rose 57% to 27.4 billion hours. Only about half of those were Ryan. There are other players. Daily active users rose 41% to 111.8 million. And average bookings per daily active user rose 7.1% to $12.86. I will note that average bookings do have a bit more seasonality, with Q4 being stronger when the parents are spending all the money on Roblox cards. But the general trend overall has been increasing. It's just not in a linear fashion compared to the other metrics, but that is expected given the cadence of it as well. Concurrent users have pushed past 30 million users, with management noting 20 million of those concurrent users at certain times are playing a single game, Grow a Garden, which I think Ryan's familiar with. He was mentioning it to me earlier, some of the games that he's played. Daily user growth had high engagement with 5 games, Grow a Garden, Steel Brainrot, Brookhaven, 99 Nights in a Forest, and Ink Games, all being the big winners of the quarter, of which 4 of those were actually launched in the last 12 months, which is actually quite key to Roblox's environment, since it needs that constant churn of those new popular games to drive both user growth and actually just retain users in general. It needs to have those hit games to actually have really any hope. This in turn requires attracting developers and brands that cater to the audience, like Lady Gaga, which Ryan was mentioning earlier, to hit its targeted 10% of the global gaming content market. As well, in the couple of graphs I have up, you can see the 13 and over category has risen at a faster rate than the under 13 category for both the hours engaged and daily active users. This is something management has been targeting to age up the platform for a very long time now, since its IPO, and they are looking to succeed doing it. I would expect that some of it's just the 13 or under users are obviously aging. They're in their teens now, so they would naturally age up the cohort, but you're also seeing growth in the under 13 as well. So good user growth overall. Shifting back to the financials, the balance sheet is great, cash rich, holding 4.7 billion in cash and investments, the investments are comprised of government debt and money market funds, so low risk securities, but they are considered long term, with about 1.6 billion in leases and debt, leading to a net cash position of 3.1 billion. As the bookings are upfront payments, so when you're buying those Roblox cards, the company benefits from receiving that cash up front before revenue and the related costs are recognized. But this leads to a massive deferred revenue liability, which they have 5.1 billion at this time. And on the flip side, right now it's really propping up those cash flows. On the flip side, if we do start to see revenue outpace bookings, it can actually create a drag on cash flows. If the Robux, the in-game currency, is spent and then redeemed by the developers once they get it's spent in game, and then they can redeem it for real life currencies, the company will see the opposite effect of what's occurring now, cash outflow in respect to its revenue. That's not the case right now, but that is a risk if you do start to see either a slowing in growth relative, or bookings slow relative to revenue growth, or if you saw an outright decline. But that's obviously not the case right now. Big growth at this time, but that is something I would like to highlight. Shifting to the guidance for 2025, revenue is expected of 4.39 billion to 4.49 billion. That's 22 to 25% growth. Bookings of 4.87 billion to 4.97 billion, 34 to 37% growth. However, they're still expecting quite a big net loss of a net loss of 1.26 billion to 1.2 billion, shifting into a further loss compared to only 941 million in the prior year, they are effectively break-even adjusted EBITDA is the expectation, a loss of 5 million to positive 55 million compared to positive EBITDA of 180 million for 2024. So I shift further into negative profitability on those two metrics. However, free cash flow, on the other hand, is expected to grow to 60 to 69% to just over a billion to 1.1 billion. So big growth on the free cash flow side, and part of that is due to share compensation, which I mentioned before, being the differential. Now, using those metrics for some forward valuations from the midpoint, forward price to sales comes in at 18.3 times, and forward price to free cash flow comes in at 77 times. Neither of those are cheap. Those are quite expensive, to say the least, even given the high revenue growth and the high free cash flow growth. So wrapping up the segment, the key user performance indicators were strong, all growing at high rates, but that hasn't been reflected in profitability for the company, only revenue and bookings. Cash flows look better due to the nature of the business and the high stock compensation, but the company is trading at just a massive multiple at this time with respect to the sales and free cash flows. The two of the better really financial metrics at this time, given the other ones are at losses. Growth upside seems to be largely accounted for, and profitability is just not there yet. So we will continue to monitor the company and the stock, and I think Ryan will continue to monitor the game in general to see if it can shift into profitability, and then further look, can they actually grow profitability on a per share basis, because there has been like pretty constant dilution. And as for our disclosure, we don't have any position in the stock, nor do employees.
Yeah. It's an interesting company. Those 3 games that you had up there. Yeah, I know those: Dress to Impress, Grow a Garden, and 99 Nights. But yeah, I mean, it is interesting moving as the kids age. Do they stay in, or how long do they stay in the row? I keep saying Roblox because that's what we buy, but it's Roblox environment, obviously. But like we have going on 20-year-old, and he doesn't really play it, but like the 10-year-old, like they're all about that environment right now. So do you age out of it? And they're trying, except now Candace plays it all the time. So I'm like, they try to get me to play it. I'm like, I can't even work that. I'm just like, I just want to throw it out the window.
Yeah, right.
But like, no, it is funny because like, and even her sister plays like too. So like, they're getting an older demographic there. I won't say too old because I shouldn't say that. They're getting an older demographic there. So, and they enjoy it. So, maybe they can get that too environment. So like, it was always like a gift card for Eden, like my daughter, and then this year she actually got, because the daughter wants her to play. So, and she's like, okay, I need a card. So she got one. It was either for her birthday or Christmas this year. So maybe the not really older, but somewhat older demographic can start gaining traction in the Roblox environment. I just get Roblox in my head because I got to go buy that card, but it's Roblox, obviously. Anyways, yeah, it's interesting. But the valuations are just massive. Like they just, it would, like, if there was another significant decline in the markets and you believed in this business long term, I mean, they could have a 60% decline and it would still be, if you looked on a valuation basic price to cash flow, it wouldn't look expressively cheap. So, like that's the issue here. If there's any wavering in their growth, any of the issues that are potential that Brett thought about bookings versus revenues, if that turns negatively, you have issues here, right? Like, so, and it could be one of those days where you see a 40% decline. Now, if everything continues the way it is now, it's well set up business. It should generate good free cash flow, but I would buy it far cheaper if I had to.
Yeah, I think that sums that up well.
All right. Aaron wants to look at Salesforce, the global giant in CRM. Do we call it that? Sales management software?
CRM, yeah.
Yeah, CRM.
Relationship management, isn't it?
Yeah, for sure.
I think
interesting year. The company's been down year to date. So, and I'm not sure if you're touching on it, but there has been some thought that AI is really going to hurt some of their platform, but they can also benefit from it. So
they're heavy into the AI. We're going to talk about that, and then at the end, we're going to talk about some of the AI exhaustion as well. But anyways, why don't we start at the beginning here? Just the discussion of the company. So Salesforce is the topic of my segment. CRM is the symbol. World's largest AI CRM platform, so customer relationship management. They provide cloud-based software solutions to companies all over the world. They're one of the biggest SaaS companies, software as a service companies in the world, and they've gone heavily into the AI investments with their data cloud and Agentforce offerings. So they trade at a price right now of about $245, 956 million shares outstanding, and a $233 billion market cap company. So one of the large caps or mega caps even. So the company's stock price has experienced fairly significant volatility over the past 12 months. It's not been a great performer in the market. So it peaked 52-week high back in December of last year. It's down right now about 27% year to date, down about 7% over the last 12 months. So let's take a look at the company's quarterly financial results, the fiscal Q1 2026 results for the period ended April 30th. Revenue was up 8%. Subscription and support revenue also up about 8%. Some expansion in operating margin, both on a GAAP and a non-GAAP. A 4% increase in operating cash flow and free cash flow. And then non-GAAP EPS up by about 5.7%. So these are fairly positive numbers across the board. But earnings per share not keeping up with revenue growth is not a great sign, especially as margins are increasing. So we'd like to see, we'd actually like to see some leverage on those earnings as well, and seeing earnings grow at a faster rate than the revenue line. In terms of segment performance, the company generated growth across all of its segments. We can see here platform and other make up about 45% of the business. Revenue is up 8% in the quarter. There's also their marketing and commerce cloud business up 9%, service cloud up 10%, and then sales cloud up 7%. So just looking at the company, the company's outlook, they did provide guidance for the full year. They're looking about 8 to 9% revenue growth for the year, so roughly in line with what they did in the first quarter. And they're looking at operating cash flow growth in the range of about 10 to 11%. So strategic priorities are to continue to integrate AI into their services. The main service offering that they have in AI is their Agent Force. This is an AI agent that is customizable for their enterprise clients. So that has really been the main focus. Now, industry trends, we're still continuing to see growth in the industry overall, but there are concerns regarding macroeconomic uncertainties and just slower spending. There's also concerns over the company's AI business as well. So AI has certainly been an avenue of growth for them and other companies as well, but it's also increased the number of competitors in the space. And in many cases, analysts and investors are wondering, can they compete can they maintain their competitive moat given how AI is transforming software and SaaS? Now, really interesting example is there's something called vibe coding. And vibe coding is essentially where you use AI to create software applications without having to code. You just use natural language. You instruct like you would ChatGPT. You can make a fully functional application. Now, there was somebody who put out a viral post. Don't know if it was on LinkedIn or Facebook, but specifically, this was the business owner that said that they vibe coded their own Salesforce replacement, got rid of their Salesforce subscription, and now just use their own coded platform. So whether or not this is true or not, or the details is unknown, but this is essentially one of the things that investors are looking at right now. One, slowing growth, and two, does AI actually eat into their competitive advantage? Balance sheet, nothing bad to say about the balance sheet. The company has a decent net cash position. So in terms of just being well situated on a solid financial foundation, they're looking good there. Valuation wise, if we look at the trailing valuation based on just reported GAAP earnings, so non-adjusted earnings, about 38 times. If we look at analyst estimates, looking at the current year, it's trading at about 21 times earnings. So this is an improvement in terms of the attractiveness of the company's valuation, but it also comes at the cost of some of those uncertainties that I was referencing. So just in terms of our take, the valuation certainly a lot more attractive than we have seen it over, say, the last 5+ years. They're doing acquisitions. They did a fairly significant one of Informatica, positioning it for future growth, also allowing it to leverage its strong financial position. Really going heavy into the AI business and agent as a service offerings. Now, again, though, AI, it's a double-edged sword for them. On one sense, it's an opportunity, but in the other sense, it's a major cash sink in terms of what they have to invest. It's a highly competitive market, and it's really potentially opening the door for many of their competitors. So we're just on the sidelines right now watching, but certainly from a fundamental basis, it's interesting and it's worth future consideration.
Yeah, I agree. I'd be on the sidelines right now, but I mean, it is a company that we'd look at. I mean, it has a long-term track record of growth. in many different environments. They've been able to navigate different challenges against the business. And if you on a forward looking, like these are adjusted numbers, but you're looking at, 21 times this year's earnings. I mean, that is for this company, that is getting to the on the historically low end for sure of its valuation. But like Aaron said, the threats out there are more significant probably than they've been, in the past 2, 3, 5 years. So, you'd want to watch that evolving environment to see if there is a threat to growth going forward. And if there is, then you have a new valuation metric. Probably you're not going to get a premium multiple. So I'm not sure if everybody's going to be able to vibe code their CRM. There's a lot that goes into that, but I mean, yeah,
that's true. Maybe
there's that too.
Maybe he vibe coded nothing. Another thing is maybe you can vibe code the CRM, but you still have to host it somewhere. You still have to maintain it.
You have to pay for the whole.
You're going to pay a fee to a SaaS provider that does it for you, even if you can do it yourself, right? It's there's that whole argument. So but that is a story that I heard, and it specifically involved Salesforce.
Interesting. Huh. Okay, well, I think that is going to close out our show for this week. What I would say is we have our 10X webinars coming up at the end of this month. So you can, we'll provide a link to where you can purchase tickets for that coming up. But I believe it's August 28th, September 2nd. August 28th is 7 p.m. Pacific. And the September 2nd is 7 p.m. Eastern. So get those tickets. There's a VIP. There's a early bird ticket as well. And we're doing a full VIP webinar on September 30th as well. That's a 5-hour. You get the full 20 stock VIP portfolio. We detail that in detail in that webinar, and that is included within the price on a good offer as well. So come to those webinars. They sell out all the time. So you can get your tickets early right now. Just go to www.keystocks.com, click on our silly faces on the big box ads, and you can get those. All right. If you're viewing this on YouTube right now, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thank you.